Crypto was sold as three things at once: the future of money, a rebellion against banks, and a shortcut to wealth that somehow never works for the person pitching it. It's always framed as innovation, but somehow the loudest crypto evangelist you know is still Venmo requesting rent. And look, I don't dislike crypto because I don't get it. I dislike it because once you actually understand how the system works, the illusion falls apart. By the end of this video, you'll see why cryptocurrency isn't a financial revolution. It's the most efficient wealth extraction machine ever built for the internet age. Let's rewind. Digital money didn't start with Bitcoin. Long before crypto Twitter existed, researchers were experimenting with anonymous online cash systems in the 1980s and 90s. Most of them failed quietly. Then, in 2009, Bitcoin arrived. The timing was perfect. Banks were collapsing, trust in governments was at rock bottom, and suddenly, here was a currency with no central authority, no banks, and no permission required. The pitch was simple: money for the people, controlled by no one. That was the dream. But fast forward to today, and crypto doesn't look like a replacement for the financial system. It looks like a shadow version of it, just less stable and with fewer rules. Start with Bitcoin itself. After more than a decade, Bitcoin still isn't used as everyday money. You're not buying groceries with it, you're not paying rent with it, you're not grabbing coffee with it. Out of hundreds of millions of businesses worldwide, only a microscopic fraction accept Bitcoin, and most of those instantly converted into dollars the second you pay, which tells you everything you need to know. As a currency, it fails the basics. Prices swing wildly, transactions are slow and expensive, fraud is everywhere. Bitcoin technically can be used for payments, but technically possible isn't the same as practically useful. What Bitcoin actually became isn't money, it's a speculative asset. People don't buy it to spend it, they buy it hoping someone else will pay more later. That's not a currency system, that's a market driven entirely by belief. And if it's just an asset, maybe it's at least a good investment. Not really. Crypto price swings are extreme, several times more volatile than the stock market. That level of risk is why serious portfolio managers limit crypto exposure to tiny percentages, if they allow it at all. This isn't because they're old-fashioned, it's because the math doesn't justify the risk. Legendary investors have said it bluntly. It doesn't produce cash flow, it doesn't generate value, it doesn't do anything. And the idea that you'll pick the next winning coin isn't strategy, it's gambling with extra steps. For every early success story, there are thousands of coins that never went anywhere. Which brings us to the real data. Since 2021, millions of cryptocurrencies have been created. More than half of them are already dead. Not down, not recovering, gone. When a company fails, shareholders may still own assets. When a crypto project collapses, all you're left with is a dead token and a deleted Discord server. Entire fortunes vanish overnight, not because of global recessions, but because the project was designed to fail once early insiders cashed out. This isn't rare, it's normal. To fix this instability, the industry introduced stablecoins, crypto tokens supposedly tied to the US dollar. The promise was safety. The reality was Terra and Luna. An algorithm tried to hold a dollar peg using incentives and token creation instead of real backing. It worked until it didn't. Once confidence cracked, the system collapsed in days. Tens of billions of dollars disappeared. No bailout, no insurance, no undo button. Just gone. At this point, you might think at least the exchanges are safe. They weren't. FTX was the crown jewel of crypto. Celebrity endorsements, major investors, political connections. And behind the scenes, customer funds were being secretly funneled into risky bets. When it collapsed, even the bankruptcy experts said they had never seen corporate controls this bad.
It wasn't just fraud, it was chaos disguised as innovation. And yet, crypto survived. Not because it worked, but because hype doesn't need results. What's driving the industry now isn't utility or progress. It's the same cycle. New coin, big promises, retail money floods in, insiders exit. Over and over. Blockchain technology may eventually find real use cases, but the current crypto ecosystem isn't finance. It's a casino where the house wears hoodies and calls itself decentralized. So no, crypto isn't the future of money. It's a digital mirage, and the closer you look, the faster it disappears.